Thank you for joining us for our Learn to Live Debt-Free and Within Your Means in 2016 webinar. My name is Charmaine Williams, and I'm the Financial Education Outreach Specialist here at Consolidated Credit, where our mission is to assist families throughout the United States in ending financial crisis and solving money management problems through education and professional counseling. What we do is free credit and budget counseling, debt management services, housing counseling, and financial education. So to get started, I have a few facts for you. A 2013 joint study by the Urban Institute and Consumer Credit Research Institute indicates that 77 million Americans, 35% of adults with credit files, have debt and collections reported in their credit files with an average debt amount of nearly $5,178. According to the Federal Reserve, Americans spend $1.30 for every dollar that they earn. And the average American has at least 13 credit obligations, 9 of which are credit cards. So on the topic of credit, what is credit? At any time a bank, finance company, or business lends you money and you agree to pay it back at a later date, you're using credit. In most cases, there is a charge for borrowing the money, either in the form of fees or interest or both. So now, your credit affects your ability to borrow and conduct transactions. Your credit score is a key factor in determining your borrowing capacity and the cost of borrowing those funds. So in general, a higher credit score rating will mean greater access to capital and lower interest rates. Your credit score can also affect the cost of insurance and the need for security deposits. So, we advise that you check your credit report at least once a year, because a lender uses a credit score as a simple way to assess risk. And the country that we live in, identity fraud hits new victims every 2 seconds. So approximately 15 million United States residents have had their identities used fraudulently each year, with financial losses totaling upwards of $50 billion. So when you pull your report, you're going to want to make sure your personal data is reporting accurately. And if you can, enroll in credit monitoring and be very careful with your information. So what's in your credit report, you may ask? There are 5 universal areas of information, or zones, that are included in every credit report. These areas will include basic information about the consumer. And these areas are your personal information, where you'd find your name, date of birth, address, etc. Credit scoring results and summary. So if you've applied for credit and you've been denied for whatever reason, they're going to say, well, maybe you have too many derogatory trade lines, you've had too many recent inquiries. This is where you would find that information. Then you'll have trade lines and derogatory accounts. So any account that you may have open, a credit card, car loan, or a mortgage. Your inquiries, that's a different section. That's anytime you've applied for credit, you're going to see it there. And then any public records that you may have on file. So if you were to owe child support, maybe you have a lien, this is where you would find that information. So here we have a sample of a credit report. Not the whole thing, just one section. And in this sample, you could see that this person has 1 public record, an item in collection, 17 trade lines, and 7 inquiries. Now you could see that the count, they have 13 revolving accounts, which should be credit cards, store cards, etc. 1 installment, which would be a car loan, and in this case, 3 mortgages, and that makes up their 17 accounts. And if you were to look more to the right, you could see that their mortgage is past due, so that they have something in collections. This is why it's important to pull your credit report and go over it with a fine-tooth comb. So what makes up your credit score? 35% of what makes up your credit score is your payment history. This is why we stress that it's very important to pay your bills on time and in full every month. 30% of that is the amounts that you owe. So the higher the balance, the closer to the limit you are, the more it's going to hurt your score. The next one is 15%, and that's the length of credit history. How long have you had these accounts open? 10% is new credit. Did you open a bunch of new credit cards? Did you just get a car loan? That's also going to ding your score a bit. And then 10% is the types of credit in use. How many revolving accounts do you have? Again, credit cards, store cards. What type of installment loans? And how many mortgages? So those are the factors that make up your credit score. Here, this is a general idea based on the FICO scale of the credit scoring 300 to 850 model. This person has a current FICO score of 780. So they maxed out their credit card. That would drop them down anywhere between $735 and $755. They're 30 days late on their mortgage. That would take it down from anywhere from $670 to $690. Settling on a credit card debt, $655 to $675. Facing a foreclosure, $620 to $640. And if for some reason they filed bankruptcy, anywhere from $540 to $560. Those are some big drops for those last two. So a credit reporting company can report most accurate negative information for 7 years and bankruptcy information for up to 10 years. Chapter 13 is reported for 7, Chapter 7 for 10. Any information about a lawsuit or an unpaid judgment against you can be reported for 7 years or until the statute of limitation runs out, whichever is longer. An employer can get a copy of an employee or prospective employee's credit report only if they agree by written consent. For those military members out there, you're going to want to call and contact the credit reporting agencies and place an active duty alert on your credit report. Because in the news, a Gainesville resident is going to prison for 5 years for stealing the identity of a U.S. soldier fighting in Iraq. This person used the soldier's identity to get a job, open bank accounts and credit card accounts, and has now been ordered to pay nearly $69,000 to the victim of his fraud. So we have a few tips on dealing with credit problems. You need to understand that there is no quick fix for credit worthiness. You can improve your credit report legitimately, but it takes time, a conscious effort, and sticking to a plan. We've all seen those signs. Credit problems, no problem. We can remove bankruptcies, judgments, liens, and bad loans from your credit file forever. Create a new credit identity legally. No, that's not going to happen. The Credit Repair Organization Act, or the CROA, makes it illegal for credit repair companies to lie about what they can do for you and to charge you before they've performed their services. So be careful out there. Other ways to deal with credit problems: make sure you go through your credit report with a fine-tooth comb. You want to identify each item in your report that you want to dispute, state the facts and reasons you dispute the information, and ask that it be removed or corrected. Credit reporting agencies must investigate the items you question within 30 days. And if an investigation doesn't resolve your dispute with the credit reporting company, you can ask that a statement of the dispute be included in your file and all future reports. So now that you've disputed and we want to start rebuilding our credit, there's certain things that you can do. In some cases, it's best to let time heal the wounds. As negative information becomes older, it becomes less important to your 3-digit number. The next thing is fix mistakes. Again, go over your credit report with a fine-tooth comb. You want to look for accounts that don't belong to you. You want to look for any incorrect balances or duplicate accounts. And those are the items that you're going to dispute. And then thirdly, build positive new credit references. If you don't have any credit cards, get a secured credit card. And that's where you place a security deposit with the lender, and that deposit will be your credit limit. Always use credit carefully and pay your bills in full and on time. And I always like to let people know that on time is on or before the due date. And carrying balances and paying interest is not necessary for rebuilding good credit. In fact, if you pay your bills in full and on time, that will help improve your score. If you are trying to avoid debt, stay clear of predatory lenders and beware of scams such as phishing scams, posing as the VA or financial institution saying they need to update credit card, bank, or other financial records. Stay away from military loans offering instant approval that have hidden fees and high interest rates. Look out for ads promising military discounts and too good to be true incentive use of stolen photos of legitimate rental properties to bait renters out of security deposits via money transfer schemes. Look out for car dealerships that have low-priced vehicles posted on classified ad websites, touted discounts for military personnel. Schemers convince buyers to wire money, however, vehicle data is stolen. Watch out for questionable charities that raise funds on behalf of military organizations. Expensive life insurance policies where high-pressured sales pitches that offer unnecessary expensive life insurance. And then there's investment scams, selling things like security systems to spouses of deployed personnel, saying the service member ordered it to protect them. If it's too much of a problem dealing with your credit issues, maybe you need to do something to get that help. So credit counseling is great. Look for a reputable organization that can advise you on managing your money and debts, help you develop a budget, and offer free educational materials and workshops. If necessary, look into a debt management plan. Creditors may agree to lower interest rates or waive certain fees while you make regular timely payments through a credit counseling organization. There's also debt settlement, which is where you negotiate with creditors to allow you to pay a settlement to resolve your debt, but there's a potential for negative impact on credit and other serious consequences. And then the last, which we try not to advise too much, you want to stay away from if at all possible, personal bankruptcy. That eliminates or restructures debt, but consequences are long-lasting and far-reaching. Remember how long a bankruptcy can stay on your credit report. So what are some of the advantages of using credit? Credit can be a good tool for emergency situations. Using a credit card is a convenient way to pay for things without having to carry large amounts of cash. Some credit card companies may offer protection for your purchases, as well as financial bonuses or rewards for card use and on-time payments. What are some of the disadvantages of using credit? Credit costs money. It can tempt you to spend more. It's very easy to pull that card out and swipe it in a store. When you make a purchase using credit, you commit to using future income to repay the loan, and then lenders will report all missed credit payments to the credit bureaus. Now we're going to talk about what are the risks of unmanaged debt. Higher interest rates, higher insurance premiums, denied credit, denied rental of an apartment. You can be denied the job that you're looking for. There's heightened stress, illness, and again, for our military personnel, security clearance can be denied. With that being said, what are your credit responsibilities? You're going to want to borrow only what you can repay. Pay all your debts promptly. And if for some reason you're having a hard time and you can't make your payment, notify your creditor right away and set up some type of arrangement for when you can make your payment. And then report lost or stolen credit cards promptly, because if you don't, you can be held liable for all of that money. We have a few tips for using credit wisely. Don't skip your payments. You will be charged interest on the outstanding balance for the month skipped, plus late fees. Don't ever go over your credit limit. Exceeding that limit or getting close to it will damage your credit history and lower your credit score. You remember that 30% that I was talking about, the amounts that you owe? Try and keep it way below the limit. Avoid using cash advances. This is usually an expensive source of funds because the interest rate applied to a cash advance will be considerably higher than the one that applies to your purchases. And avoid buying on impulse. I know we have a lot of emotional shoppers out there. I used to be one of them. Now we're going to talk about the payment trap. How long would it take you to pay off a $3,000 debt at a 14% interest rate if you only pay the $60 minimum payment? Your total interest on that debt would be $3,310. That's almost double of what you just bought. So this is why we stress pay your bills in full every month. If you're going to use your credit card, make sure you have a plan in place to pay it off before the billing cycle. You also want to remember to keep your debts at less than 10% of your income after taxes. So if you take home $750 a month, spend no more than $75 a month on credit. I know it may seem hard. Again, it's very easy to pull out that credit card and use it, but you have to remember that's money that you haven't even made yet that you're willing to pay back to these companies. So the key to credit card success is not to get trapped in the mindset of I'll buy now and pay later. When you do borrow, you want to ask yourself how and when you'll repay the debt and then how much it will cost you. What are a few warning signs of too much debt? Well, you only make the minimum payment on your credit cards each month. You have at least one credit card that is near, at, or over the credit limit. You are occasionally late in making payments on bills, credit cards, or other expenses. You use cash advances to pay other bills. You bounce checks or overdraw your bank accounts. You don't know how much total debt you have, and you don't have any savings. So when you're applying for a loan, a credit card, a car loan, etc., the lenders are going to look at what they call the 5 C's of credit. First C is capacity. How is your financial health? Can you repay the debt? How long have you been at your present job, and what is your salary? They're going to want to know, if we lend you this money or we issue you this credit, are you going to be able to pay us back? What are your current debts? What is your debt to income ratio? This is all in that first C, in the capacity. The next one is character. Do you intend to repay your debts? Have you ever used credit before? Do you pay your bills on time? Do you have a good credit report? This is why it's important to stay on top of everything and check your credit constantly. The next C is collateral. What are your resources for repaying the debt? What property do you own? Do you have a savings account? Do you have any investments that can be used as collateral in case you default on your bill? The next one is condition. And this considers the overall condition of the borrower, the lender, or the economy. There are instances when institutions are not issuing credit or making loans due to factors that are totally unrelated to you. So it may not be because your credit score or your credit report isn't that great. It could be what's going on in the economy. And the next one is credit history, right? This is measured by your credit score. It's a snapshot of a person's credit picture. And that score, again, is a numeric value that's assigned based on the borrower's level of credit risk. The higher the score, request for credit will more likely be approved at a lower interest rate. Credit scores change for good or bad over time depending on your credit history. So what are some common money issues? Impulsive spending. The source of most personal debt is spending more than you need, more than you have to. Don't go shopping when you're bored. You'll more likely end up buying things you'll rarely use. If you're prone to impulsive shopping, try to make a clear plan for what you need to buy and what you need to avoid. Stop trying to keep up with the Joneses. Do you suffer from FOMO? Fear of missing out? If you really want something, you can come back the next day. Be patient when shopping. If you see an item that you absolutely need to have, ask the clerk to hold it for you. Take half an hour to 45 minutes to walk around and look at other things or clear your head. More likely than not, you'll forget about the item and move on your way. Don't be swayed by sale techniques. Big companies try many tricks to get us to buy goods we don't really need. For example, don't be swayed by 50% off sales promotions. Just because it's on sale doesn't mean it's a good value or that you need to buy it. Don't get excited over every 3 for the price of 2 or 2 for the price of 1. Otherwise, you will just start to accumulate things you're never going to use. If you feel pressured by a salesman, walk out. If you really want the product, you can always come back. For many items such as mortgages, electricity, and gas suppliers, our existing companies take advantage of our customer loyalty by charging higher prices. This reluctance to move is called customer inertia. For example, people think it's too much of a hassle to move their mortgage, so they stick with their existing company. However, if they looked around and remortgaged, they may be able to save considerable amounts of monies. For the time involved, it's a great value. Think of it like this. If you went into a shop, would you buy goods which is exactly the same, but for 20% more expensive? I don't think so. It is true that in your 20s, it can be difficult to save because you have student loans to pay off, etc. Saving will hopefully become easier later in life. However, if you put it off too long, you'll eventually find yourself in your 50s with no savings or contingency plan. The earlier you start saving, the more productive it becomes. If you can get into a regular savings habit, it's easier to increase the monthly deposits as your financial situation improves. A budget is restraining and limits my freedom. No, that's not so. It actually does the opposite. It puts you in control and helps you achieve your financial goals. So we're going to talk about how to budget. First things first, when creating a budget, you want to list all sources of monthly income. The next step is to list your expenses. First type of expenses are fixed expenses, your mortgage or your rent, car payment. These are expenses that remain the same on a month-to-month basis. The next we have are flexible expenses. Your electric, your water, groceries, gas, credit cards. These are expenses that can change on a month-to-month basis based on usage. And then the last set are discretionary expenses. Those are things that you more want. I don't know, magazine subscriptions, going to get your nails done, going to the salon, eating out, etc. Those are things that you want to do, more fun, things that you want. So that's the last expense. What you're going to do then is total everything up. All of your income coming in, all of your expenses, the fixed, the flexible, and the discretionary. And then you're going to subtract your expenses from your income. You're either going to be in the red or the black. If you're in the red, that means you're in the negative and you're spending way more than you make. So this is where you're going to have to sit down and prioritize. Is your expense total greater than your income total? If so, you're going to need to decide what steps you can take to reduce your monthly expenses and to earn additional income, and prioritize your money. Think about what will positively affect your life in the next few years. Some reasons that personal budgets fail is failure to prioritize your expenses. What do we need versus what we want? Then failure to budget practically for normal out-of-pocket expenses like groceries and gas. Failure to plan for the unexpected. Failure to include quarterly and annual expenses. And then again, spending more money than you earn. I said it in the very beginning. Americans spend $1.30 for every dollar that you earn. So we're overspending like right off the bat. We need to do things to change that. So when you create a budget, you're creating your budget, obviously, to put money aside, to be in control of your funds. And then you're going to want to set goals that you could save money towards. So when you're setting your goals, they need to be realistic, obviously something that you can achieve, specific, something that you want to work towards, you're focused on it. It needs to have a timestamp on it. When are you going to have this done by? And it needs to be actionable. You have to put in the work towards it. You need to want to get it done. So those are the things that you have to look into when you're setting goals. Now, once you have your budget in place, your goals set, you're going to want to set up a spending plan. A spending plan can help you manage your money more effectively, live within your income limits, reduce your reliance on consumer credit, and save for the things you want. Write everything down. Every time you spend money, take a note of it. You want to know what you spend. You want to know what you spend now. To get a clear picture of how you actually spend right now, it may help to keep a spending diary for a month or two. You don't have to keep it in a book. There are apps everywhere. Everything's done on your smartphone nowadays, but keep track of it. If you have to save all your receipts and writing it down works for you, then do that. But keep track of everything that you spend. So spending step by step. First things first, pay your monthly bills. Set aside the money you'll need for your weekly and day-to-day expenses. Put money into savings. And then set aside money for larger expenses you know are coming. And if you begin to earn more, increase the amount you save as much as you can. And always, always decipher your needs from your wants. Yes, we need shelter, food, transportation. But do we need, if we can't afford it, the largest house on the block with the pool, jacuzzi, and 3-4 car garage? Do we need the Audi, or can we drive a Honda? Deciphering your needs from your wants. Remember, when you're doing a budget, include the whole family. Why? Because imitation is the sincerest form of flattery. Children learn from their parents, and you want your children to be successful. So if you have bad money management skills, they're going to grow up seeing that, and they're going to get the same bad money management skills. We talked about savings a little while ago, and savings is the key to success. You want to strive to put at least 10% of your weekly, bi-weekly, or monthly paycheck in the bank. Forego instant gratification for your long-term goals. We have a few resources to let you know about. Pulling your credit report, you're going to want to pull it from annualcreditreport.com. If you want examples of credit dispute letters, go to the FTC, business.ftc.gov. And then if you have a complaint about anything, check the CFPB, which is consumerfinance.gov. We have free online educational tools. You could check out budgetlounge.org for interactive budgeting tools with personalized advice, interactive debt calculators, comparison charts, debt analysis quizzes and personalized advice, and free downloadable PDF self-help booklets. I would just like to thank all of you for joining me today for Live Debt Free and Within Your Means in 2016.